If you're making six figures but still feeling broke by month's end, I have some bad news for you. You're not actually poor, you're just broke, which is completely different. And the reason is simple. You're following the financial rules that were designed to keep you exactly where you are. But the top 1%? They're playing a totally different game. And in the next 12 minutes, I'm going to show you exactly what that game looks like, because it turns out it's not what you've been told. Welcome back to Money Mindset TV. I'm your host, and if this is your first time here, make sure you hit subscribe because we break down the exact financial strategies that actually work in 2026, not the advice from articles written a decade ago. Okay, let's dive in. First, I need to address something that's been bothering me. We're in August of 2026, and I'm watching millions of people stress about their finances while simultaneously doing the exact same thing every month. They wake up, they check their account, they watch their paychecks disappear into a black hole, and they wonder where it all went. Meanwhile, the people who are actually building real wealth are operating with a completely different framework. And the wild part? It's not more complicated. It's actually simpler. But it requires you to think differently about your money before it even hits your checking account. Let me be clear about something before we start. This isn't a how to get rich quick video. This isn't about crypto, NFTs, or some weird loophole. This is about the unglamorous, systematic habits that the top 1% have locked into their financial lives. These are habits that most people think are boring, so they skip right past them. But boring is exactly how wealth gets built. So if you're ready to actually change your financial situation, not just talk about it, then pay attention. Let's start with habit number 1. They separate income into buckets, not just one account. Here's what the average person does. Money comes in, it goes into their checking account, and then they spend from it until it's gone. If there's anything left, maybe it goes into savings. Maybe, but the wealthy? They do something radically different. They have a system. And I mean an actual system with multiple accounts that serve specific purposes. Let me give you the framework. The moment money hits their primary income account, it's immediately distributed. Some goes to taxes, some goes to operating expenses, some goes to investments, some goes to a buffer account for emergencies, some goes to a fun money account so they don't feel deprived. But here's the key, it's all predetermined. They're not deciding what to do with their money every time they get paid. They're following a formula. And formulas remove emotion from decision-making. There's a tool that's become incredibly popular right now called bucket accounting, or sometimes people use apps like YNAB. You need a budget that automate this process. But the principle is older than that. It's about intentionality. The top 1% know exactly where every dollar is supposed to go before they even earn it. And because of that, they never accidentally spend their investment money on a new car. Now, here's what's interesting about this in 2026. Interest rates are holding steady according to the Fed's latest position, which means high-yield savings accounts are still offering meaningful returns. We're talking about accounts that give you 4 to 5% on your emergency fund while you're not even touching it. But most people don't even open these accounts because they haven't separated their money. They keep it all in a checking account, earning zero. That's literally free money they're leaving on the table every single month. So here's your action item. Open a second account today. Not tomorrow, today. Doesn't matter if it's with your current bank or a separate one. Even if you just move your emergency fund into a high-yield savings account, you've just implemented habit number 1. That's where wealth starts. Not with some complicated strategy. With basic separation. Now let's talk about habit number 2. They make money while they sleep, and they're obsessed with compounding. I'm going to say something that might sound obvious, but the way people respond to it tells me it's not. Money that's sitting in a bank account is not working for you. Money that's not invested is literally losing value. With inflation still present in 2026, cash under your mattress, or even in a regular checking account, is actually costing you money every single year. The wealthy understand something that most people intellectually know but don't actually act on. Compound interest is the eighth wonder of the world. Einstein supposedly said that, and whether he actually did or not, the principle is correct. Let me give you some real numbers. If you invest $10,000 today in an S&P 500 index fund, something as simple as VOO or SPY, and you get the historical average return of about 10% annually. In 10 years, you'll have approximately $25,000. But here's where it gets interesting. In 20 years, you'll have $67,000. In 30 years, you'll have $175,000. But that's from just one lump sum. What happens when you add to it consistently? If you invest $500 a month for the next 10 years into that same index fund, you're going to have around $100,000. But keep going for 30 years with that same monthly investment, and you're looking at over $600,000. The difference isn't the amount you're investing, it's the time. Right now, as of August 2026, the S&P 500 is up 3.4% this month alone. The Nasdaq is up 3.1%. Gold is up 8.4% for the month. The stock market is moving, and the people who are positioned to benefit are the ones who have money in the market already. If you don't, you're watching other people's money grow while yours sits idle. Here's what the top 1% are doing right now. They're not timing the market. They're not waiting for the perfect entry point. They're in the market consistently through index funds, ETFs, or a mix of both. They understand that missing just 10 of the best market days over a 20-year period can cut your returns in half. So they stay in. They don't panic sell. They don't try to pick individual stocks they read about on social media. Your action item here is even simpler than the first one. Open a brokerage account if you don't have one. Fidelity, Vanguard, Charles Schwab, they all work. And then set up automatic monthly investments into a total market index fund. $300, $500, whatever you can afford. But make it automatic. Don't let emotion make the decision. Let the system make the decision. That's habit number 2. Habit number 3 is where most people completely fall apart. They treat taxes like a business strategy, not a burden. Listen, I know taxes are boring. But boring is valuable. The IRS just clarified new rules around overtime deductions, which is a perfect example of what the wealthy are constantly doing. They're paying attention to tax policy. Most people just file their taxes once a year and hope they didn't mess up. The wealthy? They're meeting with their accountant throughout the year, making moves, positioning their income and deductions strategically. Here's the thing that blows my mind. The tax code is designed to incentivize certain behaviors. If you max out a 401k, you get a tax deduction. If you contribute to an HSA, a health savings account, you get a tax deduction, and the money grows tax-free. If you own real estate, you get depreciation deductions. If you have a side business, you can deduct home office, equipment, mileage. The code is literally telling you what to do if you want to pay less in taxes. But most people don't do it because they don't think about it until April. The top 1% are different. They structure their income across multiple buckets. Some W-2 income, some business income, some investment income, some passive income. And each one has different tax implications. They know that a capital gains tax on an investment held for over a year is lower than one held for less than a year. They know that certain investments, like municipal bonds, have tax advantages. They're not breaking the law. They're just using the law the way it's supposed to be used. Your action item. If you're making over $100,000, hire a CPA or tax strategist. Not just at tax time, for ongoing strategy. The amount of money this person can save you in 1 year will pay for their services for the next 5 years. If you're not there yet, at minimum, download the tax software that walks you through deductions. Things like the home office deduction if you work remotely, vehicle deductions if you drive for work, education deductions if you're taking courses for your job. Most people leave thousands on the table because they didn't know these existed. Now, habit number 4. They buy assets, not lifestyles. And they time their purchases. This one is brutal because it separates the wealthy from everyone else faster than anything else. And it's because most people have it backwards. They think being wealthy means being able to buy nice things. And it does, eventually, but the road to wealth is paved with unglamorous purchases. The wealthy person looks at a purchase and asks one question. Is this going to generate income or increase in value? And if the answer is no, they don't buy it. Or they delay the purchase significantly. An average person sees a luxury car and thinks, I deserve this. A wealthy person sees that same car and thinks, that's $100,000 I won't be investing that would turn into $250,000 in 20 years. But here's where it gets interesting in 2026. The wealthy are also strategic about timing. Real estate values fluctuate. Stock markets cycle. Commodity prices change. Gold is up 8.4% this month alone. And the wealthy don't panic into purchases. They wait for the right moment. If you're thinking about buying real estate, you're watching the market conditions. If you're buying stocks, you're not buying at the peak of the market when everyone's emotional. You're buying during down periods when others are scared. This doesn't mean never buy anything nice. It means the nice thing comes after you've secured your financial foundation. It means you buy the house after you've built up the down payment and your investments are working. It means you buy the car after your passive income covers your living expenses. The order matters. Your action item. Before your next significant purchase, write down whether it's an asset or an expense. If it's an expense, ask yourself if you can delay it for 6 months. If you can delay it, then take the money you would have spent and invest it. In 6 months, you'll have either forgotten about the purchase or you'll have that investment money working for you. Either way, you win. Finally, habit number 5. They build multiple income streams before they're ready. Here's the thing about waiting. It always costs you. The wealthy don't wait until they're completely stable to create a second income stream. They do it while they're still figuring everything out. And they do it because they understand something crucial. A single income stream is a single point of failure. Right now in 2026, we're seeing this play out everywhere. Someone loses their job, and suddenly they have zero income. But the person with multiple streams? They have breathing room. Maybe one stream is affected, but the others keep them going. This is why side hustles have become so important. But here's where most people mess up. They think they have to have a fully fleshed out business idea before they start. They don't. They start with something small, something simple, something they can do in 5 to 10 hours a week. Maybe it's freelancing on Upwork or Fiverr in your area of expertise. Maybe it's creating digital products. Maybe it's affiliate marketing on a blog or YouTube channel. Maybe it's consulting with businesses in your industry. The specific thing doesn't matter. What matters is that you start while you still have your main income. The reason is simple. When you're desperate, you make terrible decisions. When you're stable, you can be patient, strategic, and selective. You can turn down bad clients. You can charge what you're worth. You can build something real instead of just trying to survive. Your action item. Identify one skill you have that someone would pay for. And this week, reach out to 3 people and offer that skill. It might be writing, graphic design, accounting, coaching, personal training, social media management. I don't care what it is. But make the offer. You'll be shocked at how many people say yes. And suddenly, you have a second income stream. Before we wrap up, I want to address something. If you've watched this video and you're thinking, yeah, that sounds great, but it's too hard. I don't have time. I don't have money to invest. I don't have skills to monetize. Then I need to tell you something. That's the narrative that keeps you broke. That's the story that protects you from having to take responsibility for your financial situation. The top 1% started somewhere. Most of them didn't have money. They made time. They built skills. They started small and compounded. And the only difference between them and you is that they decided to implement these habits instead of just learning about them. So here's my challenge to you. Pick one habit. Just one. The account separation, the index fund investment, the tax strategy, the asset-focused purchasing, or the second income stream. Pick one and implement it this week. Not next month. Not when everything is perfect. This week, and then come back and tell me in the comments which one you chose and what happened. I read every comment, and I love seeing people actually take action. If you found this valuable, please subscribe. Hit the bell notification so you don't miss videos like this one, and share this with someone you care about who needs to hear it. Their future self will thank you. Thanks for watching Money Mindset TV. I'll see you in the next one.